I think developing a great experience or a great game is like by far the most important thing. Because if you do that, we're very confident that revenue will come. But because crypto is fundamentally built on a financial system, there's almost no reason that revenue shouldn't be available day one.
Nothing said on 0x Research is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and any views expressed by anyone on the show are solely our opinions, not financial advice. Boccaccio, Ryan, and our guests may hold positions in the companies, funds, or projects discussed. What's up, guys? Welcome back to another episode of 0x Research. Today I'm joined by Carl Vogel and Mike Dudas from Six Man Ventures, as well as Ryan from Blockworks Research. Carl, Mike, thanks for coming on.
Thanks for having us.
Thank you.
Excited to chat.
I guess to get us started, I want to chat to you guys about investing in app over infrastructure, because typically I feel like most people associate VCs with investing in infra. Do you think we have too much infrastructure and that's why you're focused on apps, or do you just see there being more opportunity in investing in apps as opposed to infrastructure?
Yeah, it's a great question. I'll start. Actually, I was at Solana Crossroads before recently being a token, and I was on a VC panel there. And basically, this is the number one question we see that comes up on any sort of venture conversation is where should capital be allocated in the ecosystem, and are we over-indexing to one area versus the other? My general take is we have too many investments in generalizable block space. And what I mean is, if you look at the total generalized block space out there, in other words, not specific to a particular use case, just general L1 space, I haven't done the math, but I would assume we're using less than 1% and maybe even less than 0.1% of available block space with actual information. And as part of that, it creates this flywheel where investors invest in an L1 and an overpriced valuation. This L1 runs a playbook to try to get some sort of ecosystem going on it, runs some sort of likely alternative market making strategy to keep the token price at an arbitrarily high valuation. And so what you end up with is this cycle of investors thinking about investing in L1, it will at least trade at 500 million to $1 billion. And so that playbook has been run a lot. And for a long time, it was actually the right strategy. I mean, if you think back to the FAT protocol thesis, I don't know when it was introduced, but its general framing is unlike in Web 2, where the applications accrued all of the value compared to the cloud providers generally. In crypto, especially because of priority fees and minor extractable value, basically the L1s themselves are going to accrue a dominant share of the value. And that's what we've seen. However, like stepping back, us at Six Man Ventures, our background is in consumer and in mainly building applications and companies on the blockchain. And so, as part of that, our thesis has always been we want to invest not in the infrastructure per se or explicitly, but in the ecosystems and apps that are going to be bringing hundreds of millions of users on chain. Otherwise, what are we doing here? And as part of that thesis, that led us to the Solana ecosystem in 2020 because it was the only place to build high performing applications. And what we've seen is since that period of time, apps have actually done quite well, or a handful of apps have done quite well. If you look at the revenue generated by OpenSea during the last cycle, you look at the revenue of StepN, you look at the revenue of Magic Eden. This cycle, I think the two largest, what I'll call fat app winners, have been Hyperliquid and Pump.Fun. And as part of that, they've demonstrated that by creating a compelling product experience, you can generate hundreds of millions of dollars in revenue. And I think apps are therefore now becoming more acceptable to VCs to invest in because they actually see that some of these are able to generate revenue. So stepping back, we have way too much generalizable L1 block space in our personal view. There are particular types of infrastructure which I think we are underdeveloped as an ecosystem, but across the board, that playbook has been run. So
Two
let me
other
know if
things
that
that I'll
helps, or
add.
if you want to dive anywhere specific. But that's
Yeah.
my high level framing.
Two other things that I'll add are the reason so much capital is allocated to infrastructure and historically has been is because you can actually write larger checks into these things. And that is the business model of many of the mega VCs and the majority of capital raised in the space. So you do have some sort of incentives that don't necessarily align with what's actually ultimately needed in the ecosystem for use. Second piece is to that, apps don't always require as much capital to get to wild revenue generation outcomes. Hyperliquid, I think they didn't raise any outside capital and invested, I think, tens of millions, not hundreds of millions like you see in many L1s, L2s. And Pump.Fun, I believe, raised less than $3 million and has done almost 700 million in revenue. So they're not as capital intensive, and it is actually harder to do. The reason we do it is because we are company builders. Our partnership has started 6 companies between us, and we have spent a lot of time building businesses, and there's a deep need for that in the market. So we actually also have what we believe to be a competitive advantage in helping people who want to build durable businesses that will generate fees in the future. And we think there's going to be a lot more of those. And it's not just in the speculative stuff, perps trading, and meme coins, but you're starting to see it in stable coins. You're starting to see it in DePIN, and I'm sure we'll talk more about that in this conversation.
Yeah. I want to dive into the apps, but before we get started on that, I want to ask, do you think that the L1 or the L2, the chain premium is going to go away soon with the generalizable blockchains being overinvested into? Do you think I guess we're kind of seeing it now, but do you think that trend continues? Have we found the final alternative for a chain or not yet?
Yeah, so I'll start and then Carl can go deeper. What I think you're going to see is a bifurcation, and I do think the market will correct, and a number of the extraneous, unused L2s and general purpose L1s truly will trend towards zero. And you're already seeing that with a bunch of the EVM L2s trending towards zero pretty quickly. You're also going to see that with like DA layers and other sort of key infrastructure that just goes unused. What you then will see is the handful of chains that actually do build real ecosystems where fees are generated. The Solanas of the world, probably Hyperliquid, and there will be others, I believe, would increase in value. Athena launched their chain of Securitize. Like if there's actual usage there could be a lot of upside on things like that. But again, the rest of it is zero. The one category that's going to continue to be sort of a thorn and probably pretty frustrating is the OG L1s that trade like memes, right? The Cardanos of the world and the Litecoins. Just they have broad distribution, they have brands, but I think we don't really consider those when we think of venture investable things.
Yeah, I
Anything
agree.
you wanna
I think it's a really good summary.
Perfect. Okay, kind of bouncing off that, so you said you guys are company builders, and you work very closely with teams. Do you tell them to launch on specific chains? Is that part of your focus?
So I'll start again. We would say that there's a handful of chains that we think have reached sort of a level of stability, a level of capital availability, and a level of number of participants where it makes sense for somebody to launch, where they're not taking on a significant additional risk beyond company building. It's hard enough to build an early stage company, whether it's consumer or business app or product. Taking on chain risk and using one that gives you a grant but has nobody on the chain is just a risk you should not be taking. And I see too many people fail in that. So we will recommend a handful of ecosystems that we think that have demonstrated success, like Solana, that are emerging to have different app use cases, like Base. But we wouldn't recommend that you go build on, a Bitcoin L2 or one of the generalizable, alt EVMs right now. The interesting one, obviously, is Sui, and Carl can probably expand upon this, but it does feel like that ecosystem is starting to gain momentum in a couple of different use cases, and it's sort of just moving out of the risk stage of will that go away.
Yep. And one other one I would add is Monad to that list. So we're really big fans of Keone and what Monad is building. And in an industry that has a lot of, let's say, grift and unused block space, I think Monad has been able to develop an unbelievably strong community and also an underlying technology and thesis that is compelling to people and builders looking to launch high performance applications. So I think Sui has been in the game for a long time. I think with the, let's say, restructuring at Aptos and obviously what's happened at Movement Labs, I think they're really emerging as one of the primary destinations for developers looking to build on Move. And so we're already starting to see that. We've done a number of Sui investments over the years, and we have a good relationship with that team, and I expect they'll continue to grow. So those are the other two. But again, in a case like Monad, we've talked to a number of terrific teams, and Mike and I have both angeled into the ecosystem, but it's a little bit challenging to underwrite a consumer product at a high valuation on an unlaunched chain. It's just risk compounding on risk. So we do see a lot of builders moving to Solana and Base, and it's interesting. We're also friends with Alliance, and their data would support a similar thesis that Base and Solana tend to be the two places where most consumer projects are being built.
That makes sense. I want to kind of dive deeper on that Monad point because I think on our side, we also see a lot of people say Monad is great. Because I do think that the approach that they're taking, like they're on both the software and hardware side, is unique in that it is trying to bring the EVM back. But like you said, it's unlaunched. And I'm curious how that, you said you can't underwrite it, but I'm curious what your thoughts are on when would you say Monad is not a success? Or how would you say it's not a success? Because they raised a lot of money. And I guess that's my question. Like, do you think the EVM is necessary that people can't just choose Solana over the EVM?
Yeah, I mean, there's a number of ways to look at this. I think ultimately, Monad going live this year with a complete ecosystem of high performance teams where a user can come in and engage with a variety of different products. I think to me that is the number one metric of success, um, and I think they're well on their way to do so. I think from an investor perspective, you have to look at ultimately where the token trades and relative to its overall place and significance in the crypto ecosystem. And so, it might be a success for ecosystem and for developers and community, but ultimately, if the token is only trading at a third of what paradigm led an investment in, then I would say from their perspective, it's like not a success just on paper and definition. But I think it's also important to recognize that sometimes these take time to develop. I think if you look at the case of Sui and other ecosystems, it takes years sometimes to truly develop a set of strong, a strong cohort of developers. So I don't want to put too much pressure on an ecosystem that on day one launch they have, hundreds of thousands and millions of users active, and let's say 500, transactions per second as like the only way that a chain can achieve success. But I just look at the high level markers. And, the last piece of this is when I go to a conference, I'm always looking to meet new people and maintain relationships. But the third is understand developer sentiment. And when I guess another measure of success is if I'm a developer, do I see a thriving opportunity to build a business if I do so on Monad? And that's true for any ecosystem. And that would be a number one metric that, and just heuristic from talking to developers, where do they want to build, where are they excited, and where they see the users and support from an ecosystem.
That makes sense. I guess Ryan might be a bit upset about this question, but in terms of revenue generated based off of volume, I feel like before, like over the past 2 years, we weren't thinking about revenue that much, but now everybody obviously realizes that these are businesses which need revenue. And the two that you mentioned, Pumped Up Fund and Hyperliquid, are generating revenue of volume and trading.
Yep.
Do you see there being, I guess, over the next few years, a shift towards alternative ways of generating revenue? When you talk to these apps, are you saying you need to be taking a percent off of your volume and that's how you should generate revenue? Or are there other systems that you've seen apps consider?
I imagine so. So I think what's nice about like the two best business models in crypto are issuance and trading. And so, as part of that, you look at things like Pump in particular, even Hyperliquid, where they're actually creating a market. You can make money both on the market generation and the trading of that market. And so, if you think about Web 2, it took you many years to actually truly start to monetize your product. You first learn to get users and grow potentially an ecosystem. And, only then do you start thinking about revenue. But in crypto, because trading is such a core component of these experiences, it's kind of, it'd be kind of weird for founders not to focus, not to have some sort of revenue generation mechanism day one. And that's one of the reasons that these teams have been able to generate so much revenue on so little capital invested into the business. So look, I think developing a great experience or a great game is like by far the most important thing. Because if you do that, we're very confident that revenue will come. But because crypto is fundamentally built on a financial system, there's almost no reason that revenue shouldn't be available day one. That
Yeah,
said,
and I would.
I,
Oh, sorry.
yeah, I was going to say, and just like looking beyond the trading volume, I think there's many ways to start monetizing these where you could have ad networks and various sorts of users being able to use their data in productive ways where they're actually able to generate some sort of income from sharing data with particular partners in that ecosystem, whether it's for ads, whether it's for direct marketing or other campaigns. But I think like at this point, we still haven't built that many fun apps as a crypto ecosystem, and so by far, like revenue and monetization is not the core thing we look for in any sort of business at its early stage.
But as we do look forward over the next, call it 3 to 5 years, so the things that we're investing in today, we do think that there will be more, and frankly, probably looking more like traditional types of revenue generation models. So obviously, things like DePIN, where you have called a decentralized compute network or a decentralized mapping network, and so you will have kind of traditional demand for those networks, even if the supply is created in a unique way from how it's done in called a traditional Web2 business. But the sort of pricing will be kind of like fee for usage. Another category would simply be stable coins, things like money movement. You'll charge folks maybe on volume or number of transactions, and then how that fee gets back to either equity or token holders is still TBD in many cases. But the business model is very traditional. And the last one I'll mention is things like Aave and Camino and money markets, right? You have these big lending markets where they do have traditional fee generation models. It's just a matter of who gets those flows. Again, equity holders versus token holders. And I think we're in this interesting and weird transition period where folks are experimenting into, again, who captures the value. Equity holders, is it the DAO voting to move fees out to token holders? But I think it'll become much clearer over the next couple of years.
I think that this is super interesting. I was thinking about it this morning. Crypto has this really awesome, and we're kind of going off scripture, so this is my bad. But crypto has this really interesting monetization model where like you can be very profitable on day one. But at the same time, like Web 2 is really exciting because the marginal user does not pay to access the system. Like Facebook can add an incremental user at no cost to that user. It's not the same for crypto. I'm wondering, you think about these two models and kind of the friction that they present in Web3.
Yeah, I guess my thing, I presented on this at Solana Crossroads. I built a framework on like how I think about consumer. I think if you're not involving money in the core product flows, then the next question is, does it actually need to be built on blockchain rails? It is incredibly challenging to build on blockchain relative to Web 2. And, crypto fundamentally is a financial ledger. So if money is moving as part of the core flows of the platform, then monetization of that is sort of like a pretty natural step that users would engage in. I also think generally users, in order to stand out in crypto, or just in general in the attention market that we have across both Web 2 and Web 3, users tend to engage with a product for fame, fortune, or fun. And I think if you're just building something that's fun, where there's no opportunity to get like famous on it, or like the growth virality, or to make a fortune on the product, again, then it probably doesn't need to be built on crypto rails. So my general take is, like users can come in and like have a wallet, but fundamentally, if guys a financial ledger, if you're not, yeah, if you're not making money, if money's part of the core flow, then you kind of have to be playing some sort of like cost to move that money, trade that money, or be part of that ecosystem generally.
That makes sense.
By the way, I love going off script. So if we want to continue off script, we can. I think sometimes that's where the really interesting things happen. So we can go on script or off script, whatever you want.
Um, I want to take it back on script. Unfortunately, I apologize. No, I have this question I want to ask because I don't get to. Pump fun is a difficult topic, specifically to talk about with people, because not a lot of people know that much about pump fun. Like there's a general surface level that we all know, but you guys are investors. So I want to ask, we've seen a lot of launchpads, meme coin launchpads on Base. On Solana now we have the Radium one. There's also another one, the Bonk, but I think that might be using Radium. I want to understand how you see this market shaping up. Specifically, do you think it's a winner take all, or do you think there's enough speculation and gambling to go around for all of them?
Yeah. So look, to date, so we've been investors in the company now for a little over a year, and we've seen dozens of substantial attempts to create alternative, call it token, and again, it's just a sort of byproduct of what people are interested in. That Pump.Fun is looked at as a meme coin launchpad. There are other types of tokens launched uh, on the platform, but I'm not gonna blow smoke and say that it's the majority are memes. Okay, and that's what the flavor of the day is, but it's generalizable and it could be other things. When we invested in it, it was simply create a token, really simply, that anybody can do, and it was a magical moment. So uh, Pump created a magical moment, not only just creating a token, but then getting that, sort of the bonding curve and the locked liquidity immediately when it went off the bonding curve. It was a massive, massive unlock. And what happened is it was so magical, and they had a multi-month head start that a really big ecosystem developed around it, and that has acted as a moat for them. Right? You have everything from like Telegram bots to Deck Screener and other tools that just kind of popped up. Radium originally, and now Pump has its own AMM. But basically, what we've seen is that the things that competitors are trying to attack them on are things that ultimately the customer doesn't care about. And the customer, and Elon has said this a number of times, is kind of like the degen, the token purchaser, not necessarily the creator. And that's the person that you want to be serving, and they serve them really, really well. Again, they have a like really deep liquidity. They have a big audience of people in there, and then there's the social layer that's just as important. So people are talking about the Pump tokens for a good 6 to 9 month period. Having Pump at the end of the contract address was a signal that this isn't a rug. This is something that's quote unquote legitimate. I know it sounds funny to many people to say that, but it really did act as a meaningful symbol, and the thing just works. We had people 2 weeks in saying this was going to be a 3 week trend, and on the rate that it's going, it's actually accelerating again. Pump's doing more than $1.5 million in revenue per day. They're at above a $500 million revenue run rate right now. And so there have been many competitors launched that aren't even doing 1% of Pump's volume. And I think they're an incredible team. People underestimate how much team and relentlessness and deep insight and being the original one matters. As I said, they've already built an AMM. They take risks, and then they'll back up from them. It's not working, and rejigger and then relaunch. You've seen that with their streaming function that they recently relaunched, which was their second key insight. The last thing I'll say is, and they relaunched it obviously, which with much more moderation. Last thing I'll say is they have a vision that I don't think other teams have. They don't think of themselves as a crypto company. They think of themselves as a social company. You asked about Facebook and adding the marginal user at very little cost. I mean, they can do that, and there are costs to them, but not to the user in very large numbers to just start streaming. So they have a sector of people who can be creators, who can stream, who can launch a coin, and actually might be able to make money from doing that. So it actually could be better in the long run than Facebook or TikTok, where I'm making money from day one directly from what I'm doing versus via an advertiser or a sponsor that I'm talking about, or who's slapping an ad on my creator stuff. So they've really had a bunch of key insights in a short period of time. There's no question that they're probably not going to have 95% plus market share in this category of token issuance and creation attention in 3 to 5 years. But I think they're going to have a really significant and larger share than people expect today of a much larger market, because they're thinking about this in this like creator social lens that's much bigger than even the crypto market in its entirety today, ex Bitcoin.
Yeah, can I just add to that? I think it was really well said. Like when people like last year, Pump was a meme coin launchpad, or the first half of last year, but now it's a creator platform. Um, and as part of that, when people talk about it as a meme coin launchpad, we're going to build a better one. It's kind of like they're playing last year's game. It's like you missed the plot. You're 12 months too late. Like they're already on to the next thing. And I think I don't want to say this for them, but I'm pretty sure the exact phrasing was they want to become TikTok cross Robinhood, like that kind of social finance layer where creators and their communities can grow together. That's where they're heading. And there's a whole new set of features that are going to be coming out and are being explored that are not just we're going to launch a token and make it easy. Like that's already, they've already moved well beyond that.
And people love it. The last thing I'll say about this whole category is, I'll be in Telegram chats with friends and acquaintances, and while they're saying, "Hey, this thing's nihilistic and extractive," and this, that, and the other thing, they're dropping contract addresses in and saying, "Hey, grab this runner. Here's the narrative." Blah 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 blah. So it's clear that it's human behavior that people are enjoying, and you just don't fight against human nature.
I totally second that, Mike, and that might be true for me and Bach, or in many of the same Telegram groups, and who have similar opinions. Why streaming? You could look out into the market and you could say that text-based social has been much more popular with crypto natives, and maybe it's like a ticker fits better perhaps in text-based social than it does in streaming. At the same time, like, video is an increasingly dominant form of entertainment on mobile. So, like, I don't know, why did Pump choose streaming over text?
Great question. So I think that's not accurate that most of it's happening in Telegram. I think it's downstream of streaming. I mean, if you remember the infamous LA vape cabal that was directing, so many of the sort of dollar flows and ideas, the folks in that cabal, and it even got to sort of the more mainstream streamers, were streaming tickers, talking about them, showing trading nonstop in the same way that for the last 10, 15 years, people have been doing that for gaming. Even last cycle, by the way, when ICOs were happening, the distribution of that to broader retail was happening through YouTube and other places, not like through the things that really deep crypto market participants think. The Uber driver was seeing the YouTube crazy, $10,000 gain on XRP. And again, I'm not saying that's healthy, but the trend is actually less towards text-based interactions amongst normal people and much more quick hit videos. I even see it with my own kids, who over the next decade will graduate into that cohort of people who are getting their information, their ideas, and how to spend money, etc., from quick hit video or longer streaming and live video.
That's a bit of a scary thought, but I will say I completely agree in that Twitter is dead amongst normal people, and most people stream, like younger people stream, and they also use Discord a lot. We've moved away from microblogging, which is why a lot of times I feel like when decentralized social media emulates social media, they go for like Twitter, when in fact nobody else uses Twitter. It doesn't make a lot of sense. That pump ending thing is very, very true. I remember the first few months when it started, we would just, if something didn't end with pump, we would just say, "I'm not going to buy this. It's irrelevant. It doesn't."
Yeah, and by the way, Bonk is intelligently, and I have a strong bias. Like, I'm friendly with and helped launch Bonk years ago. I'm not involved day to day at this point, but they have Bonk at the end of the Bonk launch tickers, and that does signify some affiliation in the same way that having a Penguin PFP or a CryptoPunk profile pic signaled a sort of affiliation. I just think, the pump one is a little bit broader and more mainstream at this point.
Yeah, that makes sense.
Could I ask a question? Sorry, is just on the Launchpad model, while we're still there, are there network effects to that model? Is there durability there, or is that a commodity product or feature?
I think people thought it was, so I don't think it, so it's not, it started out as the bonding curve and then the initial locked liquidity and, hey, I have confidence this token's not going to immediately rug. So that was number one. That is replicable. But as I was saying, I think the pump has done a good job of continuing to support and build out the ecosystem around them, integrate really rapidly with all the Telegram bots, with many of the chat groups. And again, they're now moving towards, they built their own AMM, so they get more of the life cycle of a token, more guarantees creators. They have a huge war chest to incentivize sort of the supply side, which I think will be really powerful. But yeah, the same things that were defensible maybe or an advantage 9 to 12 months ago, as Carl said earlier, aren't the things that will be the moat today. Really, the only moat is how ingenious are the founders at seeing around the next corner. And by the way, we saw this with our best portfolio companies from last cycle, Magic Eden being one of them, who realized NFTs were, sort of not going to be the big sustainable thing. And they elegantly transitioned cross chain to support all chains with NFTs. Then they developed their own wallet. Then they are now moving towards, they have the wallet and they're moving more towards swaps, inside of the wallet and liquid tokens. And they're doing a great job of that. So the moat is increasingly in crypto is as much people as it is technological.
And I think specifically on the technological, I would say it's a standard. So, for example, when AMMs first came out, sort of XY equals K, it was if you could become part of that standard, people immediately understood how to engage with the product and how to provide liquidity and the considerations around that from permanent loss. Back before the internet was encrypted in parts, it was, hey, don't go to that website if there's not an HTTP like an S at the end of that. It was like, oh, it's not safe. Like, don't go there. So I think same thing with the pump ender. I think that is actually more durable than anything about the design of their bonding curve or anything else. It's on the technology side, the standard, even on the NFT side, like specifically, it was the Metaplex standard. And it was like, oh, well, if you become part of the standard, now you're immediately composable with all the wallets, and there's a robust ecosystem that you can plug into. And I think that's where ultimately the power comes from. The question then is, how do they build out this pump standard? Like right now, they're just using a regular SPL, but maybe there's time where there's a specific meme coin standard. Maybe it has to do with a portion of trading revenue going back to the creator. So the creator doesn't need to sell, they just keep monetizing it. Like you can imagine, as that standard gets stronger, the moat just gets stronger as well.
What's up, guys? Today we're joined by Antonio from dYdX. Antonio, thank you so much for coming on again.
Thank you for having me.
You mentioned a sort of multi-product platform potentially coming with dYdX, spot markets, lending, maybe a wallet. Can you expand a bit on that? And also, what would that, I guess, timeline look like?
Yeah, absolutely. And just to be clear, these are all things that are very much in the speculation phase and are mostly in my mind. It's not something we're actively working on right now. Again, we're just laser focused on making dYdX perps the best they can be, but happy to talk transparently about it. To start from the beginning, I really feel like, to me at least, it's becoming clear what the winning DeFi product is overall. And I think it's going to be one that's more vertically integrated, at least from an end user, end product perspective. It's like there's going to be a number of platforms, and each one is going to have a launchpad, like a pump.fun, a spot DEX, like a Uniswap or Radium, a perps platform, potentially like NFTs if that market ever comes back, and potentially in probably lending as well and margin trading there. And that'll all be wrapped up in one end user facing product that will look something similar to a wallet. And I really think that this is the way things are going. And this is, and I see the consolidation happen, sort of the verticalization happening on this timeline. And that's part of where I get this, like the really big winners are going to happen in the next 2 to 3 years from. And I think those really big winners are going to look like this super DeFi app. And it's kind of going to be a Robinhood type product for DeFi. And you can just do one thing in all these places rather than like you got to go to a different website and connect your wallet and bridge funds. It's like, that's like okay for right now, but people are just want to go to the app store and be like, DeFi like app and press that. And then like lending, spot, perps, all this stuff. So I think that's where we're going. And there's a real question as to how does dYdX interface with that? And I think there's two potential ways, if we take this premise as probably the way things are going, that makes sense for us from a strategic perspective. The first one is that we could build that all ourselves. And we could try to make a play for building that DeFi super app, and we could build the wallets, build this builder acquire like the spot DEX and lending side and all these types of things. And that's absolutely a big option, and it's something that I am considering, probably on the like 6 to 18 month timeline. So I think there could be some exciting developments for dYdX there on that timeline. And then the second way we could approach it is really to try to be the perps provider for other people who are building this end user facing product, to sort of be more like a Radium or like a Uniswap, at least at the protocol level. And for each one of these players that are trying to build this DeFi super app, or at least as many as possible, to be the perps provider. and maybe you go to like a given wallet that you already use, and it's just like magically now it has a tab that's perps, and then under the hood that's used by dYdX, or sorry, like fulfilled by dYdX. Like that could be a big goal there. And this is still something like we're generally going after both of these strategies right now. But I think in the next 3 to 6 months, we'll have a lot more clarity on how the market is shaking out and what the best strategy for us is.
What should people look forward to over the next 3 months with regards to dYdX? What do you want them to be looking into, to be doing?
Yeah. So I think over the next 3 months, and first of all, just acknowledge the current market that we're in crypto right now. Obviously, prices are getting hammered. Obviously, trading volumes are down, vibes are bad, these sort of things. And for those of you that are still tuning into this kind of podcast on a very technical dive into a technical product within crypto, there is kind of this belief in things going back long term, and people are still trading, like they're trading less. But I think this is a great time just to really explore what's out there and reevaluate what the landscape looks like. Chances are, like, people will be making more money in the bull market whenever that comes versus this kind of bear market. You can still make money in it, and that's actually one of the cool things about perps too, is you can go short if you want to. But probably like vibes are going to be better, profits may be better in a bull market. So the thing I would say, and this is just general advice, not dYdX specific, is take this time to evaluate the landscape, evaluate new types of products, see and decide for yourself where things are going and where you should be to situate yourself for 6 months from now, 12 months from now. So, if and when there is a big new influx of new types of users, you already know that platform, you already know how to use it, and that'll give you a significant advantage over time. So that's one of the big things in terms of specifically dYdX, what to look forward to. It's just we're really trying to get in the cadence of shipping fast, of launching a lot of new types of things. And these are things that, don't sound as sexy as like, permissionless market listings or mega vaults or these kind of things. And we've launched that, but they're things that are important. It's like in the next month, we're launching TWAP orders, we're launching scale orders, just new types of ways to do risk management and enter and exit from positions, these kinds of things. We're putting a lot of work into reliability, putting a lot of work into making sure liquidity is excellent, putting a lot of work into making sure onboarding and depositing and withdrawing, all this stuff just works seamlessly. And then hopefully, I don't know if it'll be exactly 3 months, but hopefully a little bit after that, we're really going to start seeing dYdX focus more on integrations. And again, just being available to more users in more places, and hopefully it'll just pop up in more of the apps that you're already using.
Fantastic. That's great advice, and looking forward to what you guys are going to be doing over the next few months. Thanks for taking the time today, Antonio. I really appreciate it. This was fun.
Yeah, absolutely. Thanks for having me.
How do you guys define consumer crypto? I feel like it's kind of convoluted within crypto. What would you say it exactly is?
I
Like,
mean, that's not important to us. Yeah, what I'd say is like we do like the application layer. So consumer is sort of what's most commonly associated with us, just based on our history of investing in top tier teams that have made a dramatic impact on the market, from Magic Eden to Stepin to Pump. But I think like we don't say, oh, is this a consumer company or a gaming company? In fact, there's a lot of hybrid between those. We invested in a company, Sleepagachi, and they have their game coming out very soon, and like it's a game but it's also hyper social, and so I think the lines get blurred, so it's not an important distinction in the way we think. If I had to come up with an answer, it's probably there's a social element to it that does not exist, but then again, fundamentally most of the great games out there are fundamentally social, so I think it's pretty blurred.
And then what I would say, I would add to that is really consumer crypto can go across multiple things that we call other subsegments, right? Like consumer stablecoin, the ability to effectively give somebody anywhere in the world a self-custody account by which they can, access money. Like I can send money to somebody in Latin America, they can send money to me instantaneously in USD, and then have the ability to layer, for example, on top of that, stablecoin, neobank DeFi products, which can be consumer DeFi. So, hey, we can basically lend out your stable coin and earn a yield that might be higher than you'd be able to earn in traditional markets, or maybe you don't even have access to traditional markets. But it gets back to Carl's point on, this thing has to be about money, and it doesn't have to be, again, about a speculative token, but you can start to mix these pieces together on chain, give access to people who don't have it currently, and then give them direct access so that they don't have a bank intermediary that can cut them off, that can censor them. And, just a lot of powerful unlocks that can happen. The same thing, we think DePIN in many cases is consumer crypto because, hey, I can earn tokens for having, the Hive Mapper dash cam on my car, or I can earn, by having a Dawn internet node, in my house, things like that. So there's a lot of opportunities where consumer crypto maybe isn't obvious in the way that we think of it as like speculative games and trading, but they're sort of, again, traditional business models, but that can either empower the consumer in specific ways with new financial tools they didn't have before, or allow them to earn, for example, in things like DePIN where they didn't have the way to earn from excess capacity in their time before.
Makes sense. I'm gonna start asking about specific sectors a bit more. I want to start off with DePIN. Ryan is very interested in DePIN, but I don't really get it. Over the past year, we've seen it do relatively well at some points, and then not so well at other points. To me, it seems like the main issue is, and this is within all of crypto, is there needs to be a token to pay. But the issue is that token fluctuates in price. So it can cause some issues in how people are getting paid. Do you see that as being a roadblock going forward? Do you think more of them need to start paying in USDC, USDT, etc.? And second of all, where do you see the DePIN market headed? Is it still going to be network based, or are we going to get more and more exotic DePIN products?
I mean, in fact, I think we need to move less exotic into more things that companies want to buy. DePIN's had a pretty tough year the past year. I was reflecting back in late 2023 or early 2024, DePIN had this, call it 5 to 7x price run. I think that was engineered a lot by investors and liquid funds, but there was no rational reason why all of a sudden these things traded up 5x from where they were. And since then, basically, there's just been a slow decline in price. Generally, that has been in excess of where the market has gone. I think the reason there's kind of a couple things going on with DePIN right now. One is this might be a hot take, but DePIN has been hijacked in terms of investors and, let's say, founders and teams that are looking to create value for themselves, not for the community. And what I mean by that is if you look at the revenues that are like they just haven't generated that many revenues. If you look, I was actually looking at DePIN Ninja today. It's a great site built by our friends at EV3. And like none of these teams have more than $10 million of ARR going to the token. And you're like, so we have these protocols valued at hundreds of millions and in some cases billions of dollars, and we have like less than $10 million in recurring revenue or any revenue whatsoever if you just annualize it. So I think like the expectations put on DePIN have are in extreme excess of the underlying fundamentals. Secondly, is that the revenue is actually not going to the token. I was talking to a major DePIN leader, and roughly only 30% of revenue actually goes to the token. And I was recently talking to another known DePIN leader, like protocol, and they didn't even know offhand what percent of the revenue went to the token. And so basically, in my view, we actually have a bunch of centralized companies that are using a token for distribution, which is, by the way, a fine business model, but it's not actually DePIN in any meaningful way because most of the value flow is not actually going to the token. So I think DePIN's kind of lost its way a little bit, if I'm just being perfectly honest. We've also seen every sort of DePIN being developed, but very few of them actually focusing on getting demand in. We can build supply for any sort of network that we want. So I think like that's the context I have. So I'm like fundamentally, it's one of my most exciting areas to invest in the fact that I worked at Google Nest before in IoT. I have a background in hardware from nuclear submarine design. There's crypto elements. So it's sort of like the perfect place for me to dive in. but we haven't seen as many exciting teams as I thought we were going to over the course of the past 12 months. I think what we have is a lot of terrific engineers and founders, but we haven't yet figured out how to take these systems and productize them in a way that companies are willing to pay large amounts of money. And so that might be that we're generating data that isn't helpful, or maybe it's purely just a sort of broken sales process that's taken place. So what we really look for now in DePIN projects is not just can they build a system, but can they hire the executive team that can actually sell this data with the required SLAs that's required for larger enterprises to actually sign multi-million-dollar contracts. Um, I'll pause there because that was sort of a lot of context on DePIN. Let me know if you want to dive into anything more specific on
Yeah,
that.
what I'd like to add is to your question of, so I do think in many cases it makes sense to have DePIN networks on crypto rails for payments. I do think we may start to see more USDC payments, to your question, than payments in the native tokens, because the market has basically said, participants have said, mainly because of what Carl was saying, there's not really value accrual to the tokens in most current constructs. And or there just isn't demand when people receive them. You receive your Bitcoin as a miner, people do sell their Bitcoin, but there's like demand for it on the other side. There really isn't that marginal buyer for a DePIN token. No smart financial person is going to look at many of these protocols and say, I want to buy that from the Hive map or sorry, I don't want to mention specific ones, or Helium. They're some of the best projects, but there's just historically not been a lot of demand for these tokens. Their trading volume is low because the financial investor doesn't see a reason to purchase that token from the miner. Okay, so you're getting them sold, they have sell pressure, there's not a marginal buyer, there's no volume, and the prices don't go anywhere. There are ways to change that by making the token more valuable. Hey, maybe you get more benefits for staking, but you're going to need fee accrual. We get the question about buyback and burn. I know Carl doesn't love that as a general purpose model. It really all does boil down to the labs entities, the equity holders that sit on top of these protocols need to start treating them not just as protocols that they can build equity-based businesses on top of, but ones where they actually do value the protocol participants with that sort of Web3 ethos. And I think this is what Carl was getting at, where we're going to actually drive value to the token and give people a reason to hold it. Otherwise, we're just going to see no volumes and plummeting prices. And it's not clear that they'll become great venture businesses, even if they're interesting products and valuable networks for the world.
I think that makes sense. I feel like we never had that second wave of protocols for DePIN where we had it within like other parts of crypto, where the equity token dichotomy got fixed up a little bit, and it was a bit more clear with value accrual. Especially after the SEC change happened, there was like
It's
a shift.
It's starting a little bit. I would say, like, we are investors, for example, in IO.net. So I think in areas like compute and areas we invested in Data Hive, there's another one called Grass that are basically using a distributed group of folks to to obtain, again, one of them, IONet compute, Data Hive data. And but again, the long-term key here, those are like virtual networks in a way. It's all about compute. But I do think they are a second wave of the DePIN thesis. So again, distributed supply with some demand, but there is a chance, and these teams are now approaching it, and we're counseling the teams that we've invested in to begin in earnest as they're generating revenue and real ARR to move that token not to equity holders in totality, but towards token holders, because the investors in these protocols now, we're doing it right, are both equity holders and token holders, right? And so there's only so much value in the network. Let's move it out to the place where the actual participants, again, the suppliers and the folks who buy demand exist.
I think DePIN, like the path dependency kind of sucked. And just to be clear, like I like the DePIN model. I wouldn't like, I don't like love DePIN as like a sector. Like I'm not saying like buy the DePIN ETF and get like beta exposure. I think you have to be really highly selective. But I think the path dependency really sucked. Like the crypto kind of just realized over the last 18 months that valuations matter and that maybe you should take a look at revenue. And the interesting thing about a lot of the the DePIN networks is that like they have longer sales cycles than a DEX, for example. It's like you open up a spot DEX, the traders come in and they spend money, and you see number go up. But like in many of these instances, like for data DAOs or for something like a Hive Mapper or even perhaps a Helium that are working on these larger single customer deals, it could take a long time for that revenue to get in the door. And like these things were trading at times at multi-billion-dollar valuations. So I think like that path dependency of like watching this like token premium kind of dissipate at the same time that these tokens were, or that these teams were going to these enterprises and saying like, yeah, there's a token, it's kind of weird, the SEC like kind of hates us, maybe they'll like us one day, oh by the way, like we're selling useful service for you, like, and then to watch token price go down, like I think they just got hit um by pretty negative path dependency. You guys are a little closer to the metal than we are. Like, do you think that that's a legitimate framing?
I do think there was the token model. Like, if you said, hey, there was no SEC considerations, or there was a very clear, maybe more specifically, there was a very clear path to distribute revenues as you would a traditional equity, and there's a way for token-based projects to do that. I think we'd probably see some changes in the model, but I might even go so far to say as revenue is a meme. And what I mean is, we haven't figured out in crypto how to pay money from these treasuries back to the users themselves. Like you look at Uniswap and others, like the fee switch is still off, right? And so actually, like, sure, it's generating revenue and these teams are generating revenue. The only thing that signifies is a demand signal on the other side. But for any sort of value-based investor, it's still not like I'm not getting any dividends from these things. I'm not actually, that revenue is in no way impacting my ability to hold this token. So I would say still revenue is a meme. I think in most things, like you could probably say it's a meme and it's mostly right. I think before it was just the growth of the network and the vision was the meme. Now revenue is a meme where we're applying a premium, but we actually haven't closed the loop in how do we build a fundamental based business here. I do think with improvements in market structure, it will help, but I don't see that really materializing and teams really using this new structure for like until next cycle. Like it's not going to really influence things over the next 6 to 12 months.
Mike, you brought up compute networks. They haven't worked out very well so far. The one that you did bring up, which I feel like has actually done relatively okay, is Grass. I think Data Hive is a competitor to Grass, but we've seen that people aren't particularly interested in GPUs, but they are interested in, I guess, AI labs are interested in data. Do you see there being a shift in that? Like on our end, Ryan, correct me if I'm wrong, but we don't really see how compute is going to be, like decentralized compute is going to be able to compete versus data feels more like a natural fit. I'm curious if you guys have a different take on that.
Basically, look, another issue with DePIN is revenues are not posted on chain. We know the Grass team, we like the Grass team, but like my general take is with any DePIN project, if that revenue is not flowing on chain, is it really a DePIN project? And then secondly is, can I even trust it? Like I can't trust a team, any team that they say we're making this much revenue, but it's not actually like visible. Like how are you? And by the way, in traditional equities, nothing's on chain, but there's clear disclosures, right? That are audited. Like there's not like audited disclosures coming from these teams. So to say that Grass is working, I don't know. Maybe like it could be. I just don't have a strong point of view on that. I can tell from our company Data Hive, there are definitely buyers of this type of data out there. So it's reasonable to assume that this has substantial revenue potential. Um, on the side around compute, I I mean we see that IONET and others are doing millions of dollars in revenue, and if not like tens of millions of dollars. So I think like from a thesis perspective, distributed compute with low latency is a superior product than what you can get through a centralized solution. So fundamentally, to me, like the thesis is still right for these networks. And I do think they're going to continue to grow. Like, I don't think distributed compute is over. In fact, it's like one of the, I think, bright spots of the DePIN ecosystem because it's so widely applicable to any startup and company building in this AI space, which is the most fundamental technology we've seen for the past decade. That's my take.
Yeah, I mean, so IONET does have real revenues. To your point, they don't report all of them publicly, but they're doing on an annualized basis many tens of millions of dollars in total network earnings. So, how much? So there's two numbers, but the point is the folks who are providing compute are earning on an annualized basis, mid mid eight figures.
Perfect. I want to get into. I asked this to free VCs over the last week. I want to ask you guys as well. Should VCs benchmark to Bitcoin or not? This is, I guess, it's like
Yeah,
kind
I
of last.
listened to I listened to like Haseeb and Glork go on for 20, 30 minutes on this, I feel like. So I would strongly say no at this point. If we talk to an LP, like we're in the process of beginning of the process to raise our third fund. And if when I talk to a new LP, I will say, look, if you're not allocated to Bitcoin, I'd highly recommend you should be. But that is a different product than the one that we are selling, and we believe that you should also be allocating to this. And Bitcoin is a sort of global store of value. It's sort of hard money, call it digital gold. I wouldn't say it's reached this store of value endpoint soon. So you're making a sort of bet on sort of future appreciation, and that does overtake gold. It's better version, it's portable, etc. That's just a different product than what people are purchasing, which is effectively like on chain, like Solana says, internet capital markets. That's where we're investing. And internet capital markets, by the way, includes a bunch of other things. It includes the stuff we call Web3, but effectively it's people working with, transacting in a new form of money and new internet financial networks like stablecoin networks, which are very different than sort of Visa or MasterCard. DeFi, which is very different than how banking makes bankers make their money, where they're lending out your capital, kind of on their rules and paying you a little bit. Point being, these are the benchmark just is not Bitcoin anymore. Now, the next question would be, okay, what is the benchmark? And it's really difficult for a venture fund, and I think it depends on the venture fund and what they're investing in. So we're saying we invest at the app layer, like, okay, so maybe we are technology data at this point, and you should be looking at something like the NASDAQ. I haven't thought deeply about what the right benchmark is, but it's probably something closer to that than to Bitcoin.
Yeah, and the other thing is like people always, and by the way, like our fund is exceeding Bitcoin in terms of when people bought in to when we raised the fund to now, like absolutely beating Bitcoin by a substantial amount. But the thing too is like we offer it's a different product. It's much lower volatility. Like if you look at our gains, and it's basically just gone straight up to the right. And if you're a manager at a family office and you lose 10% on the month or the quarter, like you could get fired. Like a lot of these traditional institutions don't want that level of volatility. They want it in specific areas, but like to say, oh, my entire crypto exposure is just peak volatility is outside of their mandate versus having a diverse mix of structured products that can smooth out volatility. And so because the venture funds, especially like ours, and I'm assuming most of the top funds, they can in the venture fund themselves also do liquid assets. So we can take on higher degrees of volatility while also making sure we have an underlying strong base of like high growth companies in the portfolio. So it's a different product. I think it's a weird benchmark to set out. It's kind of like saying if you're a Web2 SaaS VC, should you benchmark against like Bitcoin? It's like, well, no, like it's just a different asset class with a different set of priorities, outcomes, and volatility structure.
So have you guys found yourselves investing in more liquid venture bets like Aave or et cetera, or are you still doing mainly private markets?
What we found is we did when we started fund two like 3 years ago, we didn't think, oh, we're going to become liquid traders. Like that wasn't in our vision. But what as venture firms, like ideally one of our best strengths is developing a strong thesis on how a market is going to evolve. And because many of these companies in crypto are not just private, there's liquid components to them, it would almost be irresponsible for us to not take that thesis and say there's actually liquid investments today that align to the theses that we have.
Yeah.
And so we found ourselves starting to buy large amounts of Solana and large amounts of Bitcoin and other assets when they were much lower in price because it aligned to our thesis on how crypto is going to evolve. And as a fund, we're continuing to buy liquid assets that align to the thesis that we're already developing as part of the private market structure. And I expect we're going to keep doing more of it because honestly, we just keep being better at that as we continue as a fund.
That makes sense. Do you believe that we will see more liquid funds? Because like historically, I feel like crypto has been dominated by the VCs. Do you see there being more liquid funds going forward?
Not if they continue to lose 15 to 20% in a single month. I mean, I think it's like the thing is we always oscillate in the market in terms of how the like what the investors want, right? There's times where in a bear market they really want venture funds because they know that they're investing at great valuations into the next generation of companies and can capitalize. But in a bull market where there's peak volatility, they're like, oh, if I get into a liquid fund, I can start to realize, let's say, an immediate 50% gain on something within the course of a month. And so it just oscillates. Like we've been in this game long enough where we've seen peak demand for venture, peak demand for liquid. In fact, now, like I would say 6 months ago, there's peak demand for liquid funds. And now I think we're starting to see more of a demand back to venture or some more evergreen type structure that takes both these products together into one. And generally, I think it's a little bit of a weird distinction because we know and love a lot of the top liquid funds. They have venture portfolios, like they have
Yep.
venture side pockets carve out. Likewise, we're a venture fund that has a large amount of liquid carve out. So ultimately, hybrid is the best structure. And over time, we see more and more funds evolving into a hybrid structure across both.
Yeah, particularly, I don't think we're going to see a massive increase in the number of liquid funds because but what I do think you're going to see the best investors who, for the last 10 years, a large portion of them have been VCs getting into liquid tokens in more size and more variety. But a pure liquid fund, I still believe today, is at a disadvantage because the market is not rational. It is extremely difficult to underwrite specific liquid token purchases because there's a lot of uncertainty around, again, whether fee switches will be activated. Will people invest based on fundamentals? If they invest based on fundamentals, what will those fundamentals be? And we're just seeing far too much skew in the market from specific exchanges, marketing activities that often aren't organic, market making strategies that aren't organic. And I tweeted about one example this morning. I could not tell you at all why Soul Layer, which has less than 1 million Soul staked, is trading at 2x the FDV of Jito, which has 20 times as much Soul staked, generates significant revenue, has a fully fleshed governance process that will drive revenue back to token holders. I don't get it at all. The market is not rational. There's a price dislocation there. And so I don't see how you can have a purely successful, purely liquid token strategy right now when that Soul Layer token has 5x since February, and I think Jito might even be down. But it's just clearly a stronger protocol today. And by the way, you could argue growth. Neither one, they're not. Soul Layer's not growing their stake at a faster rate than Jito. So it's a puzzler. That's just one case study. And disclosure, we are investors in Jito, but the point is there's a number of those across every sector that you look at.
I think over the past month, people have realized how serious market maker engineering can be within crypto. And I feel like Soul Layer is, I mean, I don't know. It could be people think it's a growth story, but to me, it seems like it's part of a different sect of price.
Yeah, what I will say there is like we've started to understand how it happens, and just through conversations and rooms with different people, I think the biggest mistake the market can make is assuming that Movement Labs is the end of it. Like there's many protocols out there that are following similar strategies, and I guess I would just as an investor to like all of your investors without giving true financial advice, just like look at the fundamentals. And it's easy to chase something that has no liquidity and it seems to only go up when the market is going down, but like know that at some point those prices will not be sustained, especially once market makers turn off certain programs. So
Or investors unlock, and there's a lot more, supply overhang and things like that. So Markets need to mature. I do think so. Just to get back to your original question, there will be more liquid funds and much more liquid capital managed in the future. We believe crypto as a non-Bitcoin asset class will continue to grow in size and importance and usage. But I don't think it's going to be very easy to be a liquid fund over the transition period of the next 3 years.
That makes sense. Carl, you don't like buyback and burn when I don't mind it in specific cases. Why don't you like buyback and burn? I agree that there's definitely better ways to return value to tokens, but what do you think is the better alternative, and why don't you like it?
I think spending the money on actual real growth. Like
Yeah.
this is basically just financial engineering. And look, if you're a massive public company with a huge cash treasury, sure, then that might be a great strategy. But like these things are so volatile with most of the time very little underlying revenue that it's hard to sit there and say, hey, the best thing we can do with our capital is simply to like buy back our token. It's like, no, why don't you go market? Why don't you go open like operations in new regions? Like, why don't you do any one of these other methods to actually grow your underlying business? It's like the best thing we can do is just buy back the token. And here's the thing, I think like buyback and burn is like, it's a meme itself. But like fundamentally, if the company's actually produced more revenue and more growth with that, like obviously there's some sort of return on invested capital of or OIC that if I take this money and put it in, eventually that should come back to my business in some sort of fundamentals. So it's ludicrous to me that companies are doing large buyback and burns with their tokens instead of actually trying to grow their core business at these stages. Again, if you're super
Yeah.
mature, you're a Google or something, sure, but like it's crazy for me to see at this stage.
I agree with you, Carl. But I actually heard interesting pushback that got me thinking within the last few weeks. The framing was that um, yes, of course, if you're a growth stage company, it makes sense to reinvest in the business, expand the business. However, crypto businesses are essentially small businesses. And like any small business, you should return capital to, you pay yourself a big salary, you give yourself a 15% dividend a year. Like this investor, which prominent in the space, actually thinks that the you should think of these businesses more like small or medium sized businesses that return large amounts of capital per year rather than these like growth stage entities. I'm wondering what you think about that pushback.
Um, I think if you're, I mean, we talk about we're going to re-platform America's infrastructure with DePIN, and if that's the vision, then we can't be saying we're a small business that's like generating $300 a month, and we want to increase it to $500 a month. So I guess I would just, to me, it seems like it's a different vision that you're aiming for. I do think for a protocol like Aave or something that is highly let's say solidified or ossified and like is not planning on mass amounts of growth, I do think there's cases where you could say, hey, like we're not in a growth stage anymore. Like our growth is actually just financial attribution and liquidity growth and these other things that don't require underlying capital investment. But like for the vast majority of projects, they're not at that stage and they're trying to like, become a new paradigm. And you're not going to do it by destroying your growth capital. So that's my initial take. I'd obviously love to get more specific there if we had particular companies we could chat through. Also,
Yeah,
I've never done the math on this, but like we have teams talk to us, hey, should we burn 10% of the token supply? I haven't done the math to see how much capital you destroy versus like the growth in market cap. I haven't done that math. That actually really interesting math to see. But like my expectation is that most of the market doesn't give it like a shit if
Yeah.
you burn tokens and that you probably destroy more value than you actually increase on the backside of that.
yeah, I think I agree there. And also like I totally think it's context specific. Like if you are the fifth dex on AVAX and you came across a bunch of revenue, like perhaps it does make sense to return the capital there if you think that your growth is limited, right? It's like it's highly context specific.
One pushback that I've had is um, if I think a certain amount of buyback makes some sense just because the market's not mature and the market acts based on how the team acts, and market cap and price is more important than I think maybe in traditional businesses. So it makes sense to put some percent towards the buyback and revenue while keeping the majority of it for growth. I think it might help signal to people that we're doing something to return value. Because I feel like typically investors are kind of spooked about the equity token split, and also because people don't return value towards the token a lot. But apart from that, I completely agree with you, Carlin, that if you're an early stage business, you should be reinvesting in your growth. The only one that I think is acceptable, and potentially because of my bias, is hyperliquid. But anything apart from that, I think they should just be reinvesting.
Yeah, and I guess that what we really need is new market structure where there's different ways to return value beyond just like burning the token, right? Like that's the ultimate thing is that would help, and then perhaps teams would then just actually return capital rather than like doing this inefficient process of burning and then hoping that people like will actually like value that in the market itself over time.
Yeah. I feel like it's an outdated thing that is stuck from the past SEC era where we couldn't do a lot of these things, and hopefully going forward it'll be fixed. I have one more question, and that is the lack of DPI in the broader VC space. Do you guys know more about this? Do you want to chat a bit about that?
What specifically? Like, are you saying is
Ryan.
it a good thing? Is it a bad thing? Like, where do you want to take it?
I'm interested in how it's affected market structure. I think that, it's been a tough time for um, VCs who perhaps raised in 21, right?
Yeah.
And there's been historical kind of lack of DPI recently. Like, how has that affected market structure and what you guys do in competition in the VC space?
Yeah.
Yeah, so I'll start there. I think that one thing that we've seen is a move towards a number of firms that will do some of the later stage, like closer to TGE investments, and then work really hard on token as the product, centralized listings, working with market makers who can support price and sort of high FTV, low float, and then combining that with a strategy of trying to offload in OTC and private markets some of their tokens so that they can return capital so that they can raise their next fund. So you are seeing, I believe, a misallocation of capital and a strategy towards pushing value to projects, as we were talking about earlier in the conversation, that may not be as long-term sustainable as the things that you or I would like to see funded that people will be using in 10, 12 years. But those businesses take a lot longer to build the flywheel and look a little bit, a lot more like traditional businesses to get to that point. But yeah, the difficulty of many funds raising in 23 and 24 led many folks to kind of go further out on the close to token launch spectrum and to actually do deals at much higher valuations that distorted the market so that they could get into the deals. And I'll be honest, it is actually working for some of those funds, meaning they are starting to be able to return capital faster than some funds that have taken that sort of longer term view. I don't think those funds will perform as well as the investors taking a longer term view. But if you think of that venture model, which is raise new funds every 3 to 4 years, basically in the short term, in some cases, you do have an advantage for folks who I think are being a little bit cynical and therefore distorting what gets funded.
Yeah, and I guess just to add on to that, we're fortunate that our 21 vintage has already returned the fund and then more to investors. So we're not in that same situation as other funds, fortunately. I think it depends on like DPI at what cost. In other words, there's investors we see all these OTC deals going on, and there's specific investors that almost always sell their SAFs. And as long-term investors, I think if there's a firm that I know is repeatedly selling their SAFs at, let's say, a certain discount in order to get liquidity to return it to investors, I start to question if there's a pattern here. Is that the type of person we want investing in our portfolio, or somehow now is this cap table going to get altered or bastardized in some way? Like we're long-term investors, and like we plan on being long-term and not selling any sort of SAF just to make DPI to make some LP happy. The other thing that's going, so I guess the question is DPI at what cost? The other thing is like the market, I think everyone's very optimistic over the next year. And so it's like, yes, we could do tens of millions of dollars of DPI immediately today. But my question is, why would I do that if I'm optimistic that in 6 to 12 months it's going to be 2x the value on some of these liquid tokens or more? They would almost be foolish and not a fiduciary to then distribute all this capital and then not allow our LPs to return on the backside of that. So that's the question is, yeah, any fund could do DPI, but we're just very optimistic, and it's much better for the long-term health of the fund to realize those returns at the right price versus in today's market.
Perfect. I have one last question. One is, how has the VC landscape changed over the past few years? The second one is, do you guys think that the valuations are a bit high right now? I guess in general, any private market insights I would appreciate.
I can have one first. So how's it changed? I think you're starting to see a reordering of firms. Like I think 3 years ago we barely existed. So I don't think people would come to us as this tier one firm that has a mega brand 3 years ago. But what we've seen is there was some old guard VCs that have, let's say, been everyone knows playing these market manipulation type games, and potentially their brand equity has reduced over time compared to where it was 3 to 4 years ago. And likewise, there's another generation of firms, which I would certainly categorize ourselves and some other firms that we know that have really grown over the past 3 to 4 years to become a tier one firm. So we've definitely seen a restructuring. And I think the firms that have played by the rules or been good actors in the space, mostly, no firm is perfect, good actors mostly, have like continued to outperform in terms of brand equity. Like I would say both like Dragonfly and Multicoin just continue to be like exceptional brands that people are attracted to. And they've mostly been good actors in the space relative to some of the other stuff that we see across like different investors. So this reordering has been really good, and we've seen like this take place. Um, the other major change on the valuation side is people are becoming much more pragmatic. And what we've seen is the founders that want to work with top tier funds are like, they want to take a reasonable valuation. Um, and they won't go with the tier two or tier three fund for a higher valuation. So to be honest, like there's some deals that we see that are just at such a ridiculous price, we don't even consider it. But like generally deals that are really interesting with really, say, grade A founders are being done at reasonable prices most of the time. Um, so to us, valuation is not the reason we may not write a check in many cases. It's just that there's something about the thesis. We don't like the founder's not strong enough in particular areas. So it's very few times been a major detractor to us. The one area I'd say maybe just it's an important exception and is on the consumer side. Consumer requires a decent amount of luck to get right. Like you have to take a bunch of different product iterations and swings, and then you only might get lucky. It has a lower likelihood of outcome than something like infrastructure, which is more of a beta play. And so as part of that, you just can't underwrite consumer deals at high valuations because you need a lot more shots at target in order to generate some of those generational companies like Pump. So we're very specific on consumer valuation, but we've earned the brand that people want to work with us, and like we can come up with a price that's still very healthy and reasonable and higher than what you would get in the Web2 equivalent.
Yeah, one other change that we've seen is a move towards equity-based businesses being something, things that are investable, and not just, again, infrastructure equity businesses, which I think was the case in the past. It might be exchanges, it might have been like trading desks and big things like that that were generating cash fees that could pay out dividends, custody businesses. You're starting to see things in stablecoin and payments and crypto AI that it will use blockchain rails, but may not need their own proprietary token. But hey, the fact you can do micropayments, the fact that you can have provenance and proof of identity, it's like things like that where the equity can be valuable because there will be real fee generation, and a blockchain is necessary for some part of the business. So we're doing more investments in that vein, but in addition to moving a portion to just pure liquid, and then doing the sort of hybrid investments that have historically been our bread and butter, which is you get an equity plus a token warrant.
Perfect. Ryan, anything else you want to ask? You're good?
This is great. Maybe I'll just end with like a lot of the conversation today is like much more sober than, let's say, conversation 6 months ago where it's like peak optimism. I think it's much more sober in the areas we covered, but we're also highly optimistic, and we see a growing disparity between founders truly looking to build generational businesses on crypto and just the regular grifters. It's getting easier and easier to actually tell these people apart. So we're incredibly excited for the growth of our portfolio. We have a number of breakout companies that are just continuing to consume revenue and mind share. And we're still actively investing in that next generation. I know a lot of funds right now aren't deploying. A lot of them are struggling to raise their next fund, and they're vastly slowing down. Maybe I'll just end with 6man is open for business. We continue to write checks, and we're very eager to look at the next generation of companies.
Fantastic. Guys, thank you so much for coming on. This was fantastic.
Thanks for having us. It was great.
Really appreciate it, guys. Thanks so much.